very proud to introduce the next panel. The topic is Who Holds the Keys? Governance, Liability, and Control in Institutional Crypto. Moderating this session will be Keish. Thank you for joining us. Joining us is Claire Wells, welcome, Boris, and Joey Garcia from Xapo Bank. Enjoy.
Amazing. So I hope everyone's all good today. Today we're going to be talking around quite a lot of these different elements and key things that are happening within the space. I wanted to start off by asking about sort of custody within the space, because what we've seen happening recently is basically at the center of the shift of the office of the Comptroller of Currency, there was issued a letter that happened on May 7th in 2025, where they basically showed and shared that they expanded the authority of national banks and federal savings with the Federal Savings Association to provide custody services for crypto assets. And it clarifies that banks may act as both fiduciary and non-fiduciary in non-fiduciary capacities, and also outsource custody and executional services to third parties using sub-custodians. So this notably confirms that banks may facilitate crypto to fiat exchanges and settlement services, provided that they maintain robust risk management and compliance frameworks. So I just wanted to give a bit of background before I ask the question. So how does this change the institutional landscape with, banks getting back into the crypto custody? How does this change the institutional landscape? And should enterprises trust traditional banks, crypto-native custodians, and hybrid models? Who would like to take the question first?
Look, maybe introduce yourself first. So I'm Joe, I'm one of the directors of Xapo Bank. Been in the space a long time, very heavily focused on the reg side of things. So I act as a specialist consultant to United Nations, train, assess authorities on things like custody standards around the world. So what I'll say, it's really interesting, and SAB 121, we don't need to go into sort of very US heavy or specific terms. What you're seeing, I think Citibank came up relatively publicly the other day and said they're looking at sort of custody as a service, integrated payment rails, etc. You've seen, most banks now consider relative indirect exposure, but it's all around counterparty risk. So really, I don't know, the BlackRock ETF and the $120 billion or so, to an extent, that's sort of removing custody services as a risk and relying on the security of the counterpart and a listed instrument like the IBIT, etc. And that's all fine, and that's interesting. I think that as banks start to come more online, they're going to start to understand some of the issues, complexities, and difficulties within sort of custody as a service, and there are lots and lots of different angles to that. One is they're not blockchain native by birth. So like Xapo is very different. We are a Bitcoin custodian. We've been there since 2013, have migrated across into providing banking services. So we're a blockchain and Bitcoin native bank offering integrated custody. That's a blockchain native business looking at custody. If you flip it the other way and you're a bank and you want to start providing integrated stablecoin services, I've literally had discussions with the US Treasury Department who are asking questions, around the Genius Act and how they would actually integrate payment services to classic payment rails. So you have the existing financial services world doing what it does, and you have the crypto universe. And there needs to be like a closer convergence of standards and understanding, but it's miles away from that. So I think that it will come, but in answer to your question, I see it more, they'll be looking at third-party providers, integrated services. UBS have made their statements, Bank Safra have made their statements. It's sort of a plug-and-play style approach, because once you start bringing that entire universe into a banking infrastructure, it can absolutely be done, but I think it's more complex than a lot of them understand.
Hi, Boris from Concordium. We're actually a layer 1 blockchain, but I do know one or two things about custody because I'm also the founding partner, and for 7 years I was the chief commercial officer of Copper, one of the largest custodians in the crypto world. So Yes, I agree with everything that you say. Banks will always be the last of the party, however, are some sort of a gatekeeper. I think we now reached a point where the world, I think, the crypto-native world has kind of accepted the fact that you won't be able to just, flip the switch from a Monday to a Tuesday and live in a completely DLT world. Which is, I've said for years on panels of people going like, yeah, well, you're going to sit on a random Sunday in 2 years' time in your underwear and draw a new mortgage from a DeFi pool. Is like they slowly are starting to wake up because that stuff is just not going to happen. With regards to how they're going to, we had SAP 121, which was a massive issue in the US. I think now with the regulatory clarity that is coming on that front, there is some sort of a shift because it was just too expensive on the balance sheet in order to hold crypto on the balance sheet accordingly. With the capital reserves that you need to put aside. Now, technologically, I think it's not like there are so many tools out there that it's not really a problem anymore in order to figure out to do custody in some shape or form. I think on the institutional side, it's quite saturated. And what I mean there is there are providers out there of all sorts, even on the banking side, albeit some of them are a little bit more shit than others, but at the end of the day, there are solutions in order to cover your institutional Bitcoin holdings should you have them, right? I think the bigger question that we need to ask ourselves is, because I've been in this space now for 9 years and I'm getting quite bored of it, to be honest, is the fact of trying to figure out of how to make it accessible for everyday people. I'm constantly thinking of my dad, who's a very, very old man. He just about now figured it out in order to do the double click for Apple Pay, right? We are pretty much at the point now where if you try to go out and see the real world adoption, which everybody has been trying to hail off the rooftops, you need to solve for tooling. So if you try to explain to people what a mnemonic seed phrase is and how you keep your private keys safe, you might as well not start, because that's not going to happen in terms of adoption. The complexities on the pure, like when it comes to the pure crypto world, is becoming more and more complex then, because then you need to figure out staking, then you need to figure out, then depends on what you do, like baker keys, are you baking, or whatever you do, the complexity is just getting more and more. The bank's job, in my opinion, would be, it's not so much about the actual infrastructure of how to safeguard your private key, because at the end of the day, with regards to the centralization of that is a problem in itself, but it's a natural first step. My view would be, in order to kind of step away from that, because I have to say that the solutions for that exist, what Citi does, good on Citi. Like, I was in the boardrooms with State Street for over a year, and they were actually, they actually took Copper's solution and wanted to integrate that, so we had like a whole enterprise division. So I know the pain points on that front, on sitting on calls with 70 people, and some of them just figured out of how to spell the word blockchain. So I'm not relying on that group in any shape or form in order to see adoption. It's something that will naturally happen, but on the institutional side, I think we're pretty well covered. So the question with regards to what on the regulatory side needs to happen, and the Genius Act, like you just said, is definitely one that has legs if they now go through with the I forgot what they try to pass now.
Market structure.
The Clarity Act, which I don't know if it's actually going to pass the House right now. It's a little bit on shaky legs. But at that point, you actually come what also we at Concordium are doing, which is the reason why I left Copper and took Concordium on as a CEO, was in order to solve for everyday interactions on the premise of the simplest use case, in my opinion, which is, how do I pay for stuff? Like, that was ultimately, if you read the first line in the Satoshi white paper, this was the promise: global electronic peer-to-peer cash.
Exactly.
We have kind of went down a rabbit hole of like doing some complex yield DeFi farming in some pool somewhere on Uniswap, which pays you 40%. Congratulations, but 99.99% of the world has no idea of how this works, know of how to take care of the cash that they hold. If they
That's okay, right? I mean, that's how innovation happens. You know,
totally agree.
Speculative use cases have always been like the first sort of drivers in terms of innovation. And I agree, payments is the first use case that people actually understand, and we're seeing real proof of product market fit. But, you know, DLT has the power to retool FMI, rethink about how we develop tokenized product offerings with deeper, more liquid markets on a fractionalized basis, which creates, greater equality. I hear you. Payments is an important use case, and there's probably going to be the first one that's adopted, but there's so much more power that can be.
Yeah, we're not going to go into like regulatory universe breakdown stuff, but that is like a really key point. And when we talk about even just back to the question of institutional custody as a service, or what the big guys are doing, that the legal bit's also really, really important. So if you look at the bills that the US were trying to pass and went through the House last year but didn't make it through the Senate, they started to define custody guidelines, but they were basically delegating the rulemaking to the CFTC, and those rules hadn't even been written yet. So that now the Clarity Act and now the Market Infrastructure Bill are going to look at sort of custody as a service. But if you're a bank, you need to legally be very, very, very clear on where the liability sits when you're holding hundreds of billions of dollars of BTC in relation to institutional customers. If it sits directly on your balance sheet and you carry direct security risk, that's a very material thing legally for a big bank like Citi to consider. If you have to hold it on safeguarded, insolvency remote, segregated structures that are then verified and assessed and enforced by a regulator, then it's very different. But they need to do that. So if you go back to the FTX example, in the FTX days, there you had like provisions in law around the segregation of assets, but arguably an agency that didn't know how to monitor and enforce that. So then you get into the problems. And banks are much more cautious, and they're very, very slow. As Boris was saying, and I always use the example, like when the ATM came around as a concept, most banks opposed the idea of interacting with your bank account through a hole in the wall. And it was absolutely, and then when open banking or online banking came around, there was also a very direct opposition to accessing your bank account through a computer screen, and the internet that was also really, really strongly opposed. So this is almost like an evolution cycle, and they will get there, and the legislators will get there. But again, the answer to your question is that is way down the line, and I think the weighting will be to the natives and the groups, the specialists that can do it properly.
Yeah, I think that makes complete sense. It kind of segues into my next question, where I'm talking a little bit about more on the custody model with your guys' products. Could you walk us through the custody model? Where does the control sit? Who bears the liability if something goes wrong? And how do you balance like security with operational access as well?
Well, maybe I can start, because I work for Kiln. I'm the chief legal officer there, having previously served at Coinbase and Circle and a number of other fintechs and crypto companies. So at Kiln, we're the leading DeFi and staking rewards management platform. So we're a non-custodial solution that enable banks, custodians, other centralized service providers to access staking or DeFi rewards direct, or incorporate that earning functionality into their product offering. So in terms of the different models that we see both self-custodial models and custody models incorporating our technology in order to provide access to multiple DeFi or staking protocols. And what you see, building on what we were discussing previously, is multiple flavors of custody. So there'll be different use cases that want to leverage different types of custodial solutions. And in some instances, where you have potentially more sophisticated players, they'll want to have their own self-custodial solutions and retain control over their assets and how they're deployed within the ecosystem. In other instances, people want to park their assets with a custodian and forget about them, and ensure that they're like earning staking rewards or DeFi rewards, because those are anti-dilutive practices, but they don't care as much about exactly how the keys are stored or managed, etc.
Yeah, I mean, there are loads of different models. How can I put this? I think that the issues that are happening in the industry is something that everyone is learning from. So if you talk about the custody model, it doesn't mean that custody is secure and self-custody is insecure. Of course not. So custody, if you think about the Bybit hack not that long ago, So around $1.4 billion worth of Ethereum hacked from the system. That was a custodial solution. Now, they were, that was a brute force attack by the Lazarus Group on a platform. They had integrated and hacked, pieces of the contract within the safe physical device. There was not a validation of the destination addresses physically with matching the ledger devices key by key, and there was UI manipulation. There were many stages, very, very calculated attack, but that platform didn't have the right security infrastructure in place to manage that risk appropriately. For example, if it had only had 2 whitelisted addresses that a transaction could ever have been executed against as a destination address, that couldn't have happened, right? But there are platforms like us that have, nuclear vaults in the Swiss Alps as part of our MPC sharded infrastructure from a security perspective. We have all but the problem is that consumers or individuals or companies don't really know the difference between one and the other. They can't really do the appropriate level of due diligence to assess custody risk. There are also custodians that just pool tons of platforms' assets within one very, very risky destination address. There are also unhosted providers that have no idea how it really operates, and they don't even have enough trust in the 4 or 5 signatories to that wallet, and there's risk around that as well. So there are many risk factors that need to be managed. You can be ultra cautious and careful, but the problem is the industry sometimes hasn't really, well, not the industry, the commercial industry or the corporate industry or the institutional space don't yet have the level of deep understanding to assess the differences between one and the other. And that's evolving, I think, slowly, but yeah, there's a lot of work that needs to be done still. I've done some work there was one government in particular that used a multi-sig style security standard for the assets that they held, and they told me it was really, really secure. So we did like a security audit process on what they were doing, and I showed them like 550 potential errors, and they were almost like opening their eyes to understanding. And there are complexities as well. If there are updates to the protocol, quantum resistant structuring, whatever it might be, that needs to be managed as well, because some of it will and some of it won't be compatible with certain physical devices. So again, a lot of people don't fully understand that. So
I think those are all sort of technological or operational risk management pieces that you can navigate. In terms of the sort of more contractual liability exposure, those can be mitigated with we're seeing increased sort of insurance on the market and regulatory clarity, including capital adequacy requirements, is also going to help protect end users and institutions as well.
Yeah, and that's 100% right. Capital adequacy, like in the classic world. But remember, in the crypto world, you had the FATF publish a series of recommendations in 2019. Those recommendations defined the concept of a VASP, or virtual asset service provider, defined the definition of a virtual asset, very, very simple and restrictive ways. And the FATF are not a regulatory authority. They're a compliance and AML fraud-related authority. So they did not require prudential supervision and oversight over a crypto player. They required a compliance regime to be built. So many jurisdictions in the world, most countries need to comply with FATF recommendations within 12 months. Most haven't. In the UK, the MLR regime, which is a money laundering registration system, was built to comply with the FATF. The prudential framework will come out next year. Now, there are lots of countries in the world that apply compliance as a regulatory standard. And when you talk about technicalities of capital, security, governance controls, off-balance sheet risk, business continuity, all of those principles don't apply to compliance. So you can be as compliant as you like, and you can onboard people as cleanly as you like, but if you have a group of 21-year-olds managing hundreds of billions of dollars of cross-border high-volume activity, and there's going to be problems, and this is one of the things as well. That's already happened. So
I mean, there are, like, I'm wearing two hats, basically, especially on this panel here, because, like, number one, I run a layer 1 protocol.
Yeah.
So for me, in terms of adoption, what I would like to see are non-custodial solutions left, right, and center, because that gives you the freedom in order to do things. However, knowing the complexities, you know, people don't understand of what Concordium actually is to the extent, because you said something that I really want to pick up on, specifically in and around Bybit. I know Ben, I know Ben very well. At the end of the day, what it comes down to is there are two core issues. On the one side, identity and the compliance angle, which we have solved in a full privacy-preserving way. So if you're part of the Concordium ecosystem, you identify yourself, but your identity and your data is yours and only yours. So if you interact now in an ecosystem, you're able, in order to do this using zero-knowledge proofs, in order to do this in a full privacy-preserving way. So think of you interacting somewhere and you need to onboard or verify age or whatever else it is. You don't need to send a passport anymore. You don't need to send a picture of your driver's license. You have it already on the protocol level. The second part is knowing one or two things about custody is smart contracts. And smart contracts, as great as they are, for some reason they have been shoved down people's throats that suddenly also fulfill some sort of a custodial function. Like if we talk about Bybit, that was one of the core problems. They exploited the smart contract, switched the addresses, and basically were able, in order to siphon the omnibus account. Now, that's another thing that we solved, because we don't allow that to happen. Like there are smart contract standards that you should use on the premise of enforcing conditionalities. They should not be sitting there in order to fulfill any custodial related activities, which the entire world, crypto world, is currently running on, just to be clear. Like anything that you do in terms of issuance is smart contract based, whatever else. So on Concordium, you're basically able to issue on the L1 directly. For anybody that might be a little bit more advanced, so this is not like an ERC standard or a TRX standard. This is literally alongside the native currency, which in this case is CCD. So those two things open up or allowed to do one thing, and one thing very specifically, which is reduce your attack vector surface. If you then go interact, like that's the most important stuff, because there are, if I then go back to my copper hat,
yes.
there is, there are various layers. Ultimately, you need to build it like an onion, right? There is one layer that is more complex than the other, and subsequently you arrive at a probability which is so minuscule of something going wrong, but you have to build the infrastructure in a way that the only thing that can happen is that a certain room burns down, but not the entire building. Which is where, if you look at exchanges specifically, there is a lot of cash sitting in omnibus wallets. That's not the way that Copper specifically works, and a few other custodians, but we were very unique on that front, which also allowed them to kind of go into like the settlement side of things. Can't believe I'm doing adverts here for Copper, but at the end of the day, allows you, in order to solve for settlement and clearing capabilities on an infrastructural level, that can be happening very, very fast from a segregated account basis, which reduces that little add-on. Is a massive difference. If you think of, there is no wallet in theory that sits there with like 100 people's coins worth 1.4 billion. That doesn't exist. You can have it in a fully segregated manner. So two-sided, right? In terms of from a protocol level, I don't really care that much. What I do care about is adoption. And the best way to do this is to hammer into people that a non-custodial solution for everyday interaction makes a lot of sense. There are amazing solutions, wallets out there that you can do this with. Coming to your initial point again, abstracting away the complexities of like making the tooling easy. Like if you rock up and you need to explain to people, I'm saying this over and over, if you need to rock up and explain to people what mnemonic seed phrases are, how to safeguard your private keys, and then like write those 24 words down and put them in a safe, and then they're like, I'm not doing this. What if I lose this? Well, if you also lose your device and you don't have that, all your money is gone. I'm very, very sorry. Exactly. So that's not going to fly, right? So in terms of an industry, I think, to your point earlier, we've innovated quite a lot. If we're now talking about tokenizing things, but that's a separate conversation around liquidity, right? But what I'm trying to say is, like, there are two sides of the coin, where for the institutional side of things, in terms of security and key management, it does make sense. If you want to put it in a nuclear bunker in a mountain in Switzerland, be my guest. as long as that risk level is good for you and you feel comfortable with it, and two people have to run into the bunker in order to sign a transaction, fine with me, right? The other side is daily interactions. You want to be fast. You don't want to think about it, because at the end of the day, 99.999, and most of you guys here have no clue actually of how payments work. The most simple thing that you're doing on a daily basis, if you go to the corner shop and buy coffee, the shit show that happens behind the scenes in order to settle that transaction eventually is of gargantuan proportions, because it's built on a system that actually originated in the 70s, right?
Yeah.
So I'm maybe a little bit too aggressive, but I hope you get the point.
Yeah, 100%.
I don't think you were saying this, but I think we have to be careful not to conflate custody with smart contracts.
Which exactly, like, this is one of my whole beings that I'm trying to explain to people, that a smart contract should in no shape or form ever take a custodial function.
Yeah.
It shouldn't. It's amazing, in order to enforce conditionality, have like your lawyer just sit there and basically, like your escrow agent, and basically say like, yeah, sure, release funds, whatever you want to do. But it shouldn't physically hold the assets, which most of the crypto industry is currently built upon, which is a little bit a problem in my opinion.
Yeah, so
which is why protocols like Concordium make a massive difference.
let's talk about when things go wrong then. Considering speaking about the buyback hack, there's been quite a lot of vulnerabilities in the space also recently. With, what insurance and legal protections actually work when a custodian fails, or and who bears the loss is my question. Maybe more for the crowd.
I mean, the answer is it depends.
Yeah.
So that's the reality. Like, use the analogy sometimes. If you have a counterpart that's a bank or a financial institution, whether they're based or domiciled in Singapore, New York, London, or whatever, South Africa somewhere, Cape Town, the rules are not exactly the same, but they're broadly the same. In the crypto world, that is absolutely not the case. So each have different rules and standards and requirements, and there are different liabilities that can sit on different parts of the net. So if you do have a counterpart that is fully capitalized, has the appropriate insurance in place, has the proper segregation requirements, hold those assets in an off-balance sheet, insolvency remote situation, sometimes covers it with their own assets as well as a second layer of protection to external vector attacks, whatever, then it could be situation one. If you're dealing with counterpart two that has an amazing website and loads of influencers on Twitter saying, man, the safest place in the world, but they're domiciled in a country where there aren't really any rules or standards around that, then the risk is all with you, regardless of how secure you think that.
I mean, I can tell you a funny story. Like when we went down, when we went down the route, and I'm just anecdotally doing this again from Copper's side. I really should talk more about Concordium, but we were seeking in what was it, in 2019? We were seeking insurance with Aon and all those big brokers. It took ages in order to explain to them, because they're not, of how the infrastructure is set up. Once they kind of got that point, the answer was, it's going to be very difficult in order to insure you, because there is not enough risk in there. This seems very, very secure. It's like, yeah, but that's the whole point, right? So it's like, give us a huge cover. It's like, no, that's not how the insurance world works. I mean, it's so banal in many ways. I'm sure it has changed since. But look, at the end of the day, it comes down to the fact, if you don't want to think about it, which is why the whole topic about banks is an important one. Yeah. Even though, like, if you ask me that knows a little bit more about how the financial world works, to just blindly go through the world and say, I trust the bank is a very, very stupid thing to do. Because just people seem to forget what happened in 2008, 1980s, like 2000. Very interesting of how quickly people forget, and how everybody else needs to then bail them out because of the work that they do, sometimes. Not always, but sometimes. So I think when it comes to crypto specifically there, you are now faced with solutions in order to be sovereign. And now with things also like Concordium, but other chains, you can be sovereign, but you can be accountable. You can be, so you also solve for compliance-related issues that up until now, only your bank card and your bank was able to solve for, because if you need to onboard somewhere, they need to show, you need to rock up and show like what do you call it, a bank statement in order to be compliant.
Yeah.
So those things are, those are the things that I think we can change as an industry.
Yeah, but one thing I will say is, and I think all the things that we're talking about, I think lead to the same conclusion, that the individual, whether it's retail or corporate, needs to have a good degree of understanding around their counterpart in the arrangement. So even in the banking example, you have banks that offer very complex fractional reserve models, then you have banks like us that are just completely narrow. So if you have a liquidity coverage ratio like we do of 4,500%, like there's no risk around, there is no credit risk. And it's the same in the crypto world. If you have a counterpart that has masses of rehypothecation risk on what they're doing with the assets, or if you buy a corporate treasury instrument within a company that is 500x leveraged on BTC and trading derivatives to cover, I mean, there's a certain amount of risk, but they're not all the same. So not all banks are the same, not all counterparts are the same, not all platforms.
Just to make this clear, I like Xapo far more than the big bulge brackets in Canary Wharf. Just to make that clear, so you don't take that as a dig. There are different solutions for different users, right? At the end of the day, but what I'm saying is, it would be great to kind of see more people from Barclays, Barclays, Lloyds, blah blah blah, migrate to something like Xapo.
Yeah.
Because in terms of the capabilities, pure technologically, and what they can offer for the space, are far superior than anything that they can bring to the table in the course of the next 4 years.
Yeah,
So they're always going to be behind, right?
Yeah.
And I think eventually we're going to see that inflection point. People just need to understand. What I do not want is that every single user needs to understand of how hashing works, what staking means in detail, except saying like, oh, you get some interest on your money if you put it
you just
towards
need clear
That's all you need to say.
Yeah.
Like, if you try to explain to people of how crypto works, blockchain, I say this over and over, blockchain is here to be used, not understood. Because if you ask yourself, you have no idea of how the financial system works. None of you, in detail. There's only a few that understand it.
Yeah, just because I'm conscious of time, I'll leave that as a closing remark. Do you guys have any other closing remarks from the discussion we've had today, just before we wrap up?
Look, I think we're all agreeing, like, the counterparty risk and understanding is one thing, and, you know, as to Boris's point, I 100% agree. I mean, no one understands TCP/IP as a language of the internet, but all of our parents can hit the buy button and have a sofa turn up in the house the next day. And blockchain sort of integration as a natural piece of technology is something that we're all backing. We want to happen, I think.
Yeah, amazing. Thank you.
Reg clarity, I think with the market structure bill coming through in the US, that's going to help provide protection and clarity to the market so we can grow.
Thank you. Thank you, guys. Could we get a round of applause for our speakers today? Cheers.